Are you indifferent to your internal auditor's performance? Do you see internal audits as just another compliance cost you have to swallow? If so, this case study is going to sound painfully familiar. An internal audit team was recently assigned to review the order to cash, or O2C, cycle for a mid-sized manufacturing client. Eager to start, the team fired off a generic initial data request, asking for surface-level documentation. Once they got the files, they dove straight into mechanical execution, running standard three-way matches to compare purchase orders, receipts, and invoices. They had no overarching strategy. Their entire objective was simply to sift through the data and stumble upon random transaction errors. Predictably, they found a handful of operational hiccups: incorrect product descriptions, delayed dispatches, transit damages, and long pending balances. They packaged these symptoms into a report, pairing them with painfully vague recommendations like collections should be done on a timely basis and monitoring should be improved over dispatch timelines. When presented with this document, the CFO was entirely unimpressed. The auditors offered no new insights, zero root cause analysis, and absolutely no systemic solutions. The audit team simply recreated the daily MIS dashboard the CFO already reviews every morning. Because they offered nothing beyond the daily agenda, the entire exercise was perceived as a frustrating waste of time. The failure of this audit didn't actually happen during the testing phase. The process collapsed before the data request was even sent. The team completely ignored the standard industry baselines. They bypassed legacy flowcharts and established checklists. Those established baseline tools exist so auditors can rapidly execute basic compliance checks. By failing to use them, the team wasted immense time reinventing the wheel on basic transactional verification. Time is an auditor's most critical asset. Squandering it on baseline verification strips them of the ability to explore, experiment, and actually diagnose deeper systemic diseases within the company. This brings us to their second major error. They audited the transactions in a complete vacuum, never pausing to understand the company's specific strategic alignment. Consider the business context. If a manufacturer relies on exclusive agreements with a single original equipment manufacturer, their primary risks are pricing compliance and fulfillment. However, if that same company expands into secondary markets, priorities shift completely toward customer onboarding and credit limit approvals. To account for this, auditors must use the customization window. This is the vital step where they sit down with process owners to adapt legacy checklists to match the exact strategic realities of the department. Engaging in this customization process often reveals 10 to 20 critical process gaps, like misaligned software configurations, before a single transaction is even tested. Context dictates the value of the audit. Let's look at an alternate reality. A mature, risk-driven team leverages those standard checklists to quickly clear basic compliance, immediately freeing up valuable time. That saved time is reinvested into deeper root cause analytics. Instead of just telling management what went wrong, they dig in to uncover why it failed. Analyzing pending balances reveals a packaging flaw isolated to 3 SKUs that generate 60% of disputes. They deliver a systemic solution, an automated ERP block halting gate passes for customers exceeding credit limits by 5%, requiring a Level 2 finance override. Superior internal auditing abandons manual box checking. It leverages standard baselines to deliver hard-coded, systemic interventions that actually command a CFO's attention. We know you have faced this exact situation. If so, you must contact the team at Vigilant Bharat to train your internal audit team. Their training focuses heavily on understanding business objectives and providing true, measurable value addition to your organization.